Okay, so greetings to you, professors, and once again we meet to discuss issues about business management. And if you appreciate the scheme of work I shared with you, the first topic we're going to look at was the business risk and insurance. And today, precisely, we are going straight to that topic: business risks and insurance. Business risks and insurance. So I'll give each and every one of you an opportunity, or better still, those who want to contribute, the opportunity to tell us about what comes to mind by mere sight of business risks and insurance. What comes to mind? Business risks and insurance. Does it click anything? Have you come across it anywhere? Please share with us. Well, if you don't opt voluntarily, I will have to call you. So let me call the first person, Prof. Emmanuel Puchu. Business risks and insurance. What comes to mind? I would beg that because of our time, and if you want me to pass.
Good morning, sir.
Good morning.
Okay, so business risks, they are like the things businesses go through and how they can prevent what they are going through.
Okay. So according to Prof. Ima, the things businesses go through and how they deal with those things or issues. Okay, thank you very much. Professor Bridget. Professor Bridget, business risks and insurance. What comes to mind?
Sir, please. Business risks. Sir, please. Business risks and insurance are the chance that a business may suffer, lose, or fail to make profit due to the unexpected events.
Okay, that's a technical statement there. Thank you very much. I think along the line, we'll be breaking it down. Okay, let me pick the final two professors, a male and female. Then Prof. Nadom, business risk and insurance. What comes to mind?
Sir, please. Business risks are unfavorable outcomes that affect an organization's operations and finance.
Oh, okay. Okay. Thank you. Finally, Prof. Sedekep. Prof. Sedekep.
Sir, please. Insurance is any social device, institution, or firm providing financial compensation for the effects of accidents or.
Okay. Great. So let me appreciate all the responses and as well add what I think or what comes to mind when I see business risks and insurance. So I'm going to pick it from this point that in our society, we mostly see insurance companies, right? I'm sure you have seen this SIC. They have Midway Insurance. We have Glyco. Most of them even have popular adverts on television, etc. Now, what do? It seems that these companies, tend to provide reliefs in the event. They tend to provide reliefs in the event of losses or damages which may have resulted from certain events. So even for those who own vehicles, if you are driving and then you meet the police, they ask you about your insurance, right? And at that point, the expectation is that you should have insured your car so that in the event of any accident, the insurance company can compensate you and the victim, right? So this suggests to me that if we look at business risks, then it means that businesses face certain challenges or uncertainties. And even in the first place, what is risk? What is risk at all? Risk. I think we use this word, casually. So risk is the possibility of something unfortunate to happen. Okay, it is the uncertainty of an outcome that often involves either a loss or a harm. So any event that will result to a loss or harm can be termed as risk. So business risk here means that all the activities or events related to a business that can cause harm or that can make the business lose something valuable. Okay, so combining the two together means that businesses, in the course of doing their daily activities to achieve their set goal, would be faced with certain events. And these events are possible or have the potential of causing harm or losses to the business. And so it only makes sense for businesses to now look at getting insurance companies to cushion them when these events occur. That is what comes to mind when I look at business risk and insurance. But for our purpose of today's lesson, or for the purposes of today's lesson, we are going to pick these main themes. And theme number one is we'll look at the meaning of business risk, look at the types of business risks, how to manage business risks, and then the meaning of insurance. So these are the lesson objectives for today. I hope we are good to go. So let's pick the first one, business risk. And I think you have all attempted to, explain what business risk is. Let's get a technical meaning or definition for it. So business risk refers to the potential for financial loss or harm to an organization's assets, reputation, or profitability. Now, this is due to uncertainties or unexpected events that affect its provisions. So that is to say that there are some events or uncertainties that affect a business operations. There are some things when they happen, the business will suffer. And I would want my professors to tell me, because I want to believe some of the things or events that happen and makes a business suffer or makes the business lose something. So now let's go into that. What particular or specific activity or event can you say would have a negative impact on a business? Feel free to put yes. Prof. Daniel.
Maybe fire outbreak.
Exactly. Perfecto malagranto. Okay, so fire outbreak. This is an event, and you see it's uncertain. Nobody can tell that there will be a fire outbreak or otherwise. That's the uncertainty bit of the whole issue, right? So this fire outbreak will cause the business to suffer something. Okay, thank you very much, Daniela. I appreciate that. Prof. Portia, you wanted to add?
These natural disasters like flooding.
Okay, natural disasters like flooding, yes. Excessive water. But flood is one of the things I feel the way water can be very stubborn. So yes, a business can have its properties being flooded away, okay, whether a building, a vehicle, whatever. So this event, in a way, will make the business lose its assets. Okay, please, any other? Any other? We've heard of fire outbreaks. We've heard of flood or flooding. What else? Oh, there are more now. Tell me now, professors, why are you? Yes, Augustine Akoli.
Sir, please, natural disasters.
Portia has made that point already. Natural disasters like flooding. But you see, let's
Sir, please, we also have political factors.
Political factors. Okay. You can give a
Yes,
specific example, maybe election violence. Okay. Thank you. Prof. Zoe, let me hear from you.
Sir, please, poor investment.
Poor investment. Poor investment. Yes. Poor investment. Poor investment. Poor investment. So the business made bad investment. So maybe I'm trying to reshape in that point. Okay, so maybe of course, bad results of an investment. So poor investment, yes, that is valid. It's very true that the business, like what happened in Menzgold's case, that would be classified as a bad investment made by businesses who were, investing in that scheme. Okay. Finally, let me pick from Portia and then I'll continue. Posh.
Third, please, regulatory changes.
Okay, regulatory changes. Okay. Now, one thing I want you to note is that, okay, it's not always the case that that event is bad. Some events are positive. However, they have harmful effect on the business. A typical example is what Portia just said, a change in a government policy. Some years back, the government required that banks increase their minimum requirement with the Bank of Ghana, right? And this led to most of the banks, shutting down because they couldn't meet that minimum requirement. Now, if you assess that event, which is increasing the minimum requirement, we can't say that is bad because if the bank increases its minimum requirements, it's only better for customers because then in the event of any issue, the bank has sufficient resources or money to cater for customers' deposit. So it wasn't bad. However, the impact it had on these banks were very, harmful to the extent that some of the banks had to shut down. So that is it. That is a clue I wanted to. Now, I also wanted to talk about the flooding. You see, I argue that, we can also have natural floods. Don't you think so? I want to argue this point with you, professors. Natural disasters, flooding is one of them. But I'm also saying we can have a man-made disaster. And of course, flooding can be part of man-made. Do you agree or disagree?
I agree, sir.
Agree, yes. And I think in Ghana, we have a classical scenario where each time they open that dam, you see what happens. Okay, because they say the dam has reached its full capacity of storage, so they open it out. That one is not caused by God. God didn't do anything. It's human beings who are doing it. Okay, so anyway, that is just by the way. But based on the discussion so far, you can agree with me that some events may have a negative impact or may harm a business. Okay, and these are referred to as well risks. Okay, so a business risk is one that has the potential of harming or causing loss to the business and its operations. So some of the harm it may have on the business is one, maybe sales will reduce, profitability may go down, or we may lose fiscal assets. Great. So that's a business risk. Now, what are some of the types of business risk? Types of business risk. Types. So we are going to go through about 10 of them. 10 types of business risks. I would beg one of you to read out what you see on the screen for the types of business risks. Then we'll take each of them and explain. So who is going to be my reader? Augustine, I'm not calling you. Okay, Ethan.
Okay, so types of business risk. 1, market risk. 2, credit risk. 3, operational risk. 4, financial risk. And 5, strategic risk.
Thank you very much, Ethan, for that good reading. Now that we've seen these risks, so market, credit, operational, financial, strategic, I think I will not be wicked if I share it to you, professors, to explain what you think this or each risk would be. So market risk, market. Who would try for me? Market risk. What does it mean? Market risk. Market. We know a market now. Okay, Ethan wants to try. So Ethan, go ahead, and then I'll call.
Okay, so I think it's when a company's product doesn't perform as it used to, and so the consumers have changed from it, or okay, people have stopped buying more of it. Now people are buying less.
Oh, okay. Thank you. Augustine, you want to add?
Say please, yes. Say please, market risk these are the type of risk, or these are the unforeseen circumstances that happen in the market. Maybe, for example, the business, maybe the price of maybe a commodity of the business has, the government said that the price of the commodity of the business, maybe the business is selling maybe pens. Maybe the price of 1 pen is like, let's say 3 cedis. Then maybe the government said that maybe the price of the pen should drop from 3 cedis to 1 cedi, because the business aims at maximizing profit. So like this is what a risk.
Okay, thank you very much. I'll hear from Bridget and then finally Portia. So Bridget, let's hear you on market risk.
So please, market is the possibility that a business may suffer a loss due to the changes in market conditions.
Changes in market conditions. Thank you. Prof. Portia, add on and then.
So when it comes to market competition, maybe two businesses are from the same industry and they produce the same products but with different levels. So maybe if this company product is purchased more than the other business will lose profit and fortune.
Okay. Thank you very much. Any final submission? If not, then I would say that a market risk, a business market risk. Now, what is the market? You know, the market is that place where there is an exchange, okay, for products or goods, right? So people go buy and others go sell. So that's the market. Now, the market is made up of lots of factors. We have the demand factor, the supply factors, the price factors, price fluctuations factors. We have the competition, like Portia alluded to. Okay, you might not be the only business producing that particular good or supplying that particular product. Okay, right. We could have regulatory changes in the market. Okay, economic fluctuations. So we are saying that when these market factors or conditions changes, it has the potential of causing harm or losses to the business. For example, if your customers' demand shifts, so let's say we are producing what can I use? Maybe we are producing gobe. Okay, so we sell gobe and people buy. Now it so happens that the taste of our customers have changed. They don't like gobe again. That demand shift is going to lead to low sales of our gobe because now people don't like gobe. They have eaten it and they are tired. Okay, so this factor of customers shifting, okay, or change in taste is leading to a demand shift. So maybe they are not now demanding for gobe, they are looking for other alternatives. Okay, and this will reduce our sales. And if the sales of a business is reduced, you know, the potential impact it has on profit. Profit will decrease to the extent that if we are not careful, we may have to shut down the business. So market risk borders about all the changes in the market that may affect the business in a negative way. Okay, please, any question? Let me acknowledge one person just joined. I think that'll be. I'm trying to get the name so that I don't mention the wrong. But Prof, you are welcome. Okay. Yes, Moroni. Please, can you add your first name or your surname? Eugenia, do same so that I will take attendance. So use your full names. But you are welcome. So that is about market risks. Okay. All the market conditions that may impact a business success. Number 2, credit risk. Credit risks. Credit risk. Oh, look at that for me. You know, this is more of discussion, right? So I love to engage you more. Prof. Eugenia, whilst you edit your name, would you attempt to tell us what credit risks?
Good morning.
Good morning, Virginia. Or I should pass it on, you'll come later.
Yes, please.
Okay, so Eugenia is organizing herself. I'm sure today she hasn't taken her tea, that's why. But please add your name, your other name so that we have your phone. Okay, so credit risk, credit. Let me give you clues. There are some businesses when you go, you say no credit. Others too, you can have. So credit risk, what does it mean? What can you say about it? Prof. Josephine, let me hear from you. Prof. Joseph, are you there? Okay.
This guy come again.
Yes, so I wanted you to share your view about what credit risks. Credit risk, what is it?
Okay, so I'll say credit risk would be like when someone pays for something or like borrows something from a business, maybe a loan or something, and then fails to repay the organization.
Okay, so that is the gospel according to Josephine. Thank you, Josephine. Let me see who hasn't spoken so far. I think today. In fact, I love your contributing spirits so much. Keep it up. Who are these people? All of you as well. Prof. Moroni, even though you are joining us, can you share credit risk? Does it click anything? What can you say about credit risk? Credit.
So, I don't have anything right now.
Okay, so Prof would rather not share. He knows. So when I tell you, say, he knows, but he's not sure if that's the point he has to make. Anyway, so Portia. Okay, let me hear from Portia then.
Say, this credit risk is when a borrower might default on a loan or debt to the business.
Default on a loan. Okay. So a business credit risk. Now this risk is normally, the case for businesses that are into granting credits for custom or to customers, right? Or also, getting credits from other institutions. I wish I could use the key word for credit, as in free, free again. So there are some businesses where you can buy goods on credit from, and they are also able to get, resources, either money or something from other institutions like the bank. You can go to the bank for a credit facility, and a credit facility here means a loan. So we are saying that this risk really occurs when repayment becomes a problem. So, for example, we are into selling of shoes, but we allow our customers to take delivery of the shoes and pay later. So the risk here, which is a credit risk, is when our customers fail to pay or settle their debt. That's one of them. And, to some extent, the business will be forced to declaring those debts as bad. Okay, so credit risk is associated with bad debt. Now, another risk could be that we, the business, we are also owing people. We are not able to pay on time. And as a result, we are not getting the credits we used to get because of our bad, repayment strategies or program. And to some extent, there are even credit rating institutions. I think there's even applicable to countries. There are some countries, okay, who are, rated as, in fact, I don't know what to say to get you to appreciate it. But if you watch the news, you would appreciate that sometimes they'll say Ghana has been rated at this point in terms of our credit rating. Okay. And there are some ratings, if you have it as a business, nobody will give you a loan, because it means that you are very bad at paying back your debt or your credit facilities. So you can have credit rating downgrades as a risk. I think I would let you read more about this credit rating so that you can appreciate. And even countries are credit rated. Okay. I think Ghana were rated recently as I would please read further on that. Okay. But we are saying that credit risk arises from some of these factors. Either your customers defaulting to pay, and you may have to declare some of the debts bad. And then you, the business yourself, loan repayment issues. You went for loans from banks, you are not able to pay. That is also a credit risk. Okay, because that event of you not being able to pay will mean that in the future you may not get the loan from the business. And you have not, if you are not getting the loan from the bank, you cannot expand your operations. Your profits will begin to go down. And you know what that means in the end. So that is credit risk. Okay. Any questions so far? Any questions? Okay. Let's take operational risk. Operational risks. Yes, Portia.
So please, I want to That's a question on the
Okay.
credit risk.
Okay,
Can
good.
the credit risk be the business owing the creditors?
Yes, of course. So the credit rating is about the business, ability to settle its loans, right? Or its ability to settle its creditors. So if a business is rated low, it means that they are bad at settling their creditors. Okay, and that's an event that can harm the business. Because if we are rated to be low, if we are rated or we are downgraded, that means companies will not be, suppliers or even banks will not be willing to give us, that credit facility. And if your suppliers are not giving you goods on credits, you know the implications. And even the bank is not willing to give you a loan because you have been downgraded based on credit rating. That's an event that can make the business suffer. It will harm the business, right? Any other question? Okay, so we can now look at the operational risks. Operational risk. Yes, please go ahead. I think Moroni wanted to say something. Yeah, so go ahead, please.
For the operational risk, is a negative impact due to human errors or system failures.
Okay, due to human errors and system failures. Okay, thank you. Portia, you want to add?
Yeah, I'll set these from internal processes.
From internal processes. Okay. Any other? Okay, so you see, in simple terms, when we talk of operations or business operations, we are looking at the day-to-day activities that keeps the company running. So it includes all the internal systems set to make sure that the business is able to perform, right? So specifically, it involves purchasing, selling, advertising, all those things, all those activities a business would have to go to be successful. Okay, production, advertising, all those, delivering, these are all operations of a business. We are saying that there is an uncertainty or there is a danger that some of these operations or day-to-day activities may harm the business. So any operation that has the potential of harming the business is an operational risk. So if it is about production, and of course we can tell that in the production process, a lot of harm happens. Sometimes some employees lose their, their fingers or even arms because accidents happen. Okay, so by mere fact that the business would have to operationally produce, there is a potential of a harm to the company. But when employees are, getting involved in accident, they are losing either their feet or sometimes even the kind of explosives, especially when you go to the mining sector, the kind of explosive they use, a lot has happened, right? So these are operational risk. So things going wrong in the normal day-to-day activities of the business. And like Moroni suggested or stated, human errors and system failures. So somebody was supposed to probably press the fire alarm. The person forgot. And we all bent and we died. Okay, so that's operational risk. Financial risk. Financial risk. Because of time, I think I would go through the remaining. Okay, so these are risks, or these are, events or uncertainties that really affect the business finances or the company's finances. So it can either cause the business to lose finance or even shut down. Okay, so some may be liquidity problems. The business is not able to, generate cash to finance its operations. The business is not able to, even the exchange rate is one of the issues. We are fortunate currently, I think it's stable in Ghana, but it used to gallop like something. These are all events that can cause financial harm to the business. Strategic risk, strategy, right? So the word strategic from strategy, strategic risk. So we are saying that every business has a strategy, right? So if the strategy fails, then a potential harm is coming. So anytime a business strategy fails, then we say that there's been some strategic risk in there. Because then the failure of the strategy will lead to a loss or a harm on the business. For example, we are, let's say, a delivering company, and one of our strategies is we don't own any vehicle, right? We use a public transport system. So if you buy things and want to deliver to you, we'll go to the station or the bus terminal and then deliver your item. This is our strategy. Now, if it so happens that the buses or the public transport systems always delay the delivery, then this our strategy is not working. It will make us lose customers because no customer would want a delayed delivery. Okay. Likewise, we could also have our strategy where maybe this time we buy the vehicle, or we even buy a motor bicycle or whatever they call it. We buy a motor and then we get riders to ride it. That's another business strategy. What if our riders are inexperienced and that every day they are involved in an accident? Then you can tell that that strategy we chose is causing harm to the business. Okay, it's like even in school, students have their own strategy of learning. Some will wait till a day to the exam before they learn. Others will start from day one. If your strategy is causing harm to you, so that in the end you are not able to pass or you don't get some questions right, then that's a strategic risk. Okay. Let me go through the risk. Compliance risk. Compliance. So businesses are supposed to comply, or they are obliged to follow certain rules and standards as set by regulators in the industry. So for example, in Ghana, if you are into the food industry, you always need to comply with the rules and standards of the Food and Drugs Authority, FDA, right? So if you are not able to comply or follow the rules, you will suffer. FDA will shut your business down for failing to meet certain standards, right? Currently, we have the EPA, Environmental Protection Agency, who are strictly ensuring that businesses comply with certain environmental standards. Okay, so if you are setting up a business and even your environment is not clean, you are not thinking about people living around the business, EPA can come and shut you down. So that makes it a compliance risk. Because you are unable to comply, you are suffering a loss. Then cybersecurity, I think I'll leave this one to you, Professor, because you are much, cybersecurity risk. Who would talk to us about this? Cybersecurity. Oh, this one you know now. You know this cybersecurity risk. Let me call Prof. Nadum because Nadum should be knowledgeable in this. Nadum, cybersecurity.
So related to cybersecurity, cybersecurity involves threats like computer-related threats, some being hacking, breaching, the data breaches, and all that. So cybersecurity risks are risks that could affect the business in terms of the technological side.
Oh, okay. Okay. So technological sense. Thank you for that. So I agree perfectly with him. Imagine if you're a business and you're operating using WhatsApp and you get your account hacked. That's a cybersecurity risk, right? You are losing data or you are getting hacked by virtue of you using the internet. So any harm associated with use of the internet and other technology will be termed as a cybersecurity risk. Thank you very much for that. And he mentioned the example of the phishing attacks. The phishing is PHIS, HIN, right? Phishing attack, malware. I think you are doing computing, so you know a lot about these things. But I've given a typical example on WhatsApp. We get people, you say, oh, his account has been hacked, and they start demanding money. Okay, environmental risk, environmental risk. So these are possible harm or dangers in the environment of a business. But what are the environment of the business, or what is the environment of a business? I think we've spoken about this sometime, right? Okay. So whether be it internal environment or external environment, all those possible events that can harm the business is an environmental risk. Then the political risk, I think we have hinted about this. The political instability, change in government policy, etc. These can affect a business or can harm a business. And I think I give an example. When there is an electoral violence, okay, people are not satisfied with election results, they begin destroying properties and all that. If your business is around a committee, by the time you realize your building is in flames, right? Okay. Then the 10, reputational risk. Reputational risk. Reputation. The last one, reputational risk. So this really has to do with your brand. I think in Ghana, people, especially the musicians, they are very much, enthused about this, their brand. This is my brand, this is my brand. So there was a question in the chat. Let me read this. Interesting one. It says, if in a school, if students in a school are caught cheating during WASSCE or BECE, and the school is not made to be a center again, or other punishments are put in place, can you say this is a compliance risk? Of course. It is the school failed to comply with the rules and regulations of WAEC, and for that matter, is suffering that harm. So it's a compliance risk. Okay. But it's interesting how you were able to couch this example related with WASSCE for FITA. But that is a perfect, example for compliance risk. Failure to adhere to, rules and regulations set by regulators. Okay. So reputational risk, we are saying these are events that can harm your reputation as a business, like scandals, okay? If your business is involved in scandals, you are really going to suffer. Or maybe bad public relation or social media backlash. I think a lot of companies sometimes on social media, you see people talking about them. This company is bad. their delivery is not good, their product is not of quality. All these are reputational risk because they are going to harm your reputation as a business. Okay. So somebody asked if I could share the slide. Sure, I would, but trust me, all these are in your learner manuals. And I want to believe you have all downloaded the learner manual. If you haven't, please, I beg you, go and do so. Okay. But I'll share the video with you as well. So, yeah. Let's see if we can finish up with how to manage these risks we have identified, right? How to manage these risks we have identified. So to be able to manage, of course, we need to appreciate what risk management is. And I want professors to pay attention to this particular one. So what is risk management? It's the process of identifying. So you need to identify the risk. Assessing, you need to assess it. And taking steps to minimize or control. So risk management is about you identifying that possible event that can cause you harm. You have to identify it. Assessing it, you have to assess it. So if you have identified, for example, like Ethan gave, if you have identified that your student copying in the WASI is a risk, and of course we have just determined compliance risk. Even besides the compliance risk, it could fall for reputational risk, because if your school is seen to be copying, you lose your brand name. So reputational risk is also there, right? So if you identify this event of your student copying in the WASI, you have to assess it. So what is this copying thing about? Is it that they write on sheets of paper and take it to the exam hall, or they get the questions online, they solve before they enter the hall, or is it teachers who are teaching them? So you have to assess it. So after assessing, then you can now take steps to minimize or control the potential problems that could negatively affect the business organization. So that's risk management. Now we do this with several strategies. And just as I spoke about your manual, let's go into your manual and read some of these risk management options. So I think I'll be employing one of you as and when necessary. So all the risks that we discussed, they are in your manual. You can come and read that or read them. So let's look at the first option you have, to manage risk. So the first one I want to draw your attention to is diversification. Diversification. And I want somebody to read that point for me. Diversification. Yes, diversification. I think you can see it on the screen. Prof. Eugenie, I think you can read this one for me.
Please, how again?
You can read the diversification point for me.
Yes, please.
Okay.
Diversification. Diversify the range of products or services offered to reduce dependence on any single revenue stream. Expand the business into different markets or geographical regions to spread risks.
Okay. So we are saying that this is one of the ways you can manage risk. Okay, so if you are dealing with in one product, we are saying diversify. Go to other products. Don't only deal in one, so that if one fails, you have the others available to cushion you. So if you are into maybe delivering of sachet water, then you can diversify into maybe delivery of food items, so that when there is an issue with delivery of water, at least the food item option is there for you, right? To cushion your streams of income or revenue. Or you can even expand. If you're only in Cape Coast, you can expand to Accra, Kumasi. So if something happens in Cape Coast, okay, imagine if you have a business in Boko right now and you don't have any branch anywhere. Boko is now facing, conflict and challenges. So every day there are curfews and all that. So your business will suffer. But if you had diversified, you had branches in Kumasi, Takoradi, whatever, then if Boko is not functioning, you have the branches in Kumasi, Takoradi functioning and sustaining the business. So that's the bit about diversification. It's one of the key things we even do in investment, that you don't put all your eggs in one basket. You need to diversify. So if you are buying government bonds, you can also look at maybe investing in private companies, buying shares. Okay, so that is diversification. It's one of the ways to manage business risk. Then the famous one, insurance, for which you are going to talk to me about in our next meeting. Insurance. So insurance really means transferring the risk to an insurance company. So for example, if I'm a delivery company and I have identified a risk that my riders may be involved in an accident and it will cost me money, or it will harm me financially because I have to pay for the hospital bills of the rider. If probably a third party was involved, I have to compensate the person, etc. This will all cost money, right? So I transfer this to an insurance company so that when it happens, it is the insurance company that is going to compensate me or pay me the money to cater for these hospital bills, compensation of third parties, etc. So insurance actually is transfer of risk. You are transferring the risk to an insurance company, but of course not free. You would have to be paying regular amount. Normally, most of the time I think it's monthly. And we call them premiums. And I want to believe in your group discussions, it has popped up there. Okay. So you are going to be paying premiums so that in the event of the misfortune, the insurance company can compensate to premiums. Okay. Oh, sorry, my handwriting is bad. So premiums, that's premiums. Okay. So I think at least you have an idea of what insurance is, and I want to believe next week you are going to make me a happy or the happiest teacher. Okay. But of course, in that engagement, then we have the insurer and the insured. I think, let me hold on to that. Let me not spill the tea. The professors will deal with that. Okay, so that's insurance. The other one is risk avoidance. Risk avoidance. So here we can say you can avoid the risk. That is, you avoid that harmful or that uncertain event that may occur. So for example, if you are into importation, and you know that when you import your goods using the ship or by cargo, the ship or the cargo may sink. Then you can avoid that by doing what? Using the air or aircraft. So now you are avoiding the risk of losing your goods to the sea. You are going to the air, but know that as you avoid one risk, another one also evolves. Because then what if the plane also crashes, right? But you can avoid certain risks. For example, if you are producing, let's say, soap, and you know that, or you sell soups, and you know that when you produce it yourself, you may get some burns or some of the chemicals will affect you. Then you can avoid that production bit and just purchase from suppliers. So by purchasing from suppliers, you avoid the risk associated with production. And that's risk avoidance, right? Okay. Then risk mitigations, right? So the two are different. Avoiding means you don't want to have the event taking place at all. Then the mitigation is you put in controls so that when the event happens, at least it is at its minimum level. So like the example I gave, this time you are not avoiding production. You are doing production, but you have put in place mechanisms to reduce any risk that may come out of the production. So the risk of you maybe being affected by certain liquids, you wear protective clothing. If you do that, then you are doing what? You are mitigating the risk. So even for technology or cyber attacks, you see, WhatsApp, one of the things we do is to do what we call two-step verification. So that's a risk mitigation, strategy, right? You are doing that to reduce being hacked. Some people have two verification, whatever, but they are still hacked. Okay. So that is about risk mitigation. We have others like strong internal controls, legal and regulatory compliance. You implement technology and cybersecurity strategies, and then financial management. I'm sure my professors can read about this. If there are any questions when we meet in our next session, you bring them on board. So these are a few areas or few strategies for risk management. But key amongst them is insurance. And remember, our topic has that, insurance. So we are going to dig deeper into what insurance is, the various types of insurance, the principles of insurance. And I think that will take us to our last objective of the day, and that is definition of insurance. Definition of insurance, right? Or meaning of insurance. So let's discuss this, and then I think we can wrap up. I will give each and every one of you an opportunity to tell me something about insurance. What is insurance? What does it mean? So starting from top, I have Daniela. Prof. Daniela, insurance. You can give an example, you can cite a scenario, you can tell me about whatever you know about insurance. So Daniela, we are listening.
Okay, sir. So insurance is a way of protecting a business from risks.
Okay, very brief. So it's a means of protecting a business from risks. Thank you very much. Prof. Portia, you are next on the bill.
Okay, so please, insurance is a contract where you pay a premium to an insurance company and they promise to cover certain costs or losses if specific unexpected events happen.
Okay, so Portia gives us the dimension of it being a contract. A contract. Thank you. Prof. Emmanuel Kuju.
See,
Yes.
please, insurance is the way of protecting an organization financially from unexpected events.
Okay. Prof. Ethan.
Okay, so insurance is protection against any form of loss or expected events.
Okay. It seems like repetition is coming in gradually. Anyways, so let me spare the others because they also said they have said it all. But of course, you can tell me that insurance, like Portia hinted, is a contract between two parties, right? Where one party is called the insured and the other party is the insurer. Now, who is the insured and who is the insurer? I think the rest of professors can answer this question. So let me continue the list. Prof. Eugenia, who do you think is the insurer? Insurer. Or Eugenia is saying, say, you are giving me the hard or the tough question.
Your question again.
So Do you agree that in insurance we have two parties? One is called the insurer, one is called the insured. Who is the insurer?
This one is say.
Okay, Eugenia, your what do you call it? Your reactions are justified. Okay. Okay, Moroni, thank you. Please tell us, who is the insurer?
It's the person or company that make the insurance.
Okay, so it is the insurance company. The insurer is the insurance company, right? Thank you very much. So, Prof. Eugenia, sorry for putting you on the spot. So the insurer is the insurance company, like SIC, Glyco. I think now we have a lot of them. Is it Vanguard? I don't know if some are still in this. Vanguard Assurance. Hey, professors, you don't know some. You know some now. Tell me. I know of SIC, Vanguard, Glyco. Is it Me Way or My Way? Is it Me Way or My Way Insurance? Lots of them in the system. Okay. So that's the insurer. And then the insured is that individual or the company that is paying the premium. Okay. Thank you for that. Okay. So on this note, I think we'll end here. And hopefully Thursday, the first group will take us through, I think, the types of insurance, right? And then the other group will look at the principles of insurance. So I'll not talk much about insurance since you are going to tell me. Okay, so any questions so far? If there are no questions, then I'll summarize what we have discussed today and call it a wrap. Question time. Okay, so professors, today we started with business risk and insurance. And now we all appreciate that, business risks are all those possible events or uncertainties that may cause a loss or harm to the business. We've looked at the various types of business risk. We have operational risk, market risk, compliance risk, cybersecurity risk, and all the rest. We explained these types of risk, and now we went into how to manage them. And key among these management strategies is insurance. And we just ended by looking at what insurance means, and we have been able to establish that it's a contract where one party called the insured pays a regular amount called a premium to the other party called the insurer to be compensated, okay, to be compensated in the event of a misfortune or an event which was agreed in the contract. Okay. So, profs, this is few things we had to discuss today. I want to thank you very much for contributing so much, and I hope you continue your group discussions until Thursday when you present. It is my expectation that you finish it up and submit your PowerPoints in advance so that I can go through and then share with you on the D-Day for the presentation to be smooth. But group 2, I'm still waiting for your group discussion report. Prof. Ethan, you have been assigned to do that. Thank you very much. I'll see you in the next lesson. Okay.
Okay, sir.